Hello, everybody. This is Joseph Farrell with news and views from the Nefarium on Thursday, January 22nd. The year is going by in a flash, everybody, and I have an article. This is so off my beaten path for news and views, but this is so significant. I have to talk about it and give you my usual high octane speculation take on what this might spell. The article is from Zero Hedge and is titled The End of HFTs, in other words, high frequency trades, and price discovery. America's biggest money managers launch their own dark pool. And I'm going to read most of this article to you because it is so significant, in my opinion, for our high octane speculation that we indulge in here, that I have to read this to you and give you my take. So here we go. Quote, surely if high-frequency trades are so bad, then the vanilla funds will finally realize that enough is enough and take their precious order flow away from the public exchanges, right? Yes, and yet for years, the big money managers stoically took it on the chin, and whether out of laziness or some other unexplained motive, allowed their orders to continue being high frequency traded front run on public exchanges and third party dark pools year after year, making orders a cost center, boosting the case that high frequency trades aren't really bad for stocks until now. According to the Wall Street Journal, some of America's largest mutual funds and asset managers, led by Fidelity Investments, quote, are close to launching a private trading venue designed to let them buy and sell large blocks of stock without the involvement of Wall Street firms and high speed traders, according to people familiar with the matter, unquote. The new venture is the who's who of traditional asset management in the United States and includes 9 firms, including BlackRock Incorporated, Bank of New York Mellon Corporation, J.P. Morgan and Chase and Company, and T. Rowe Price Group Incorporated, who are saying goodbye to the high-frequency trade markets, idem est public exchanges, and, quote, forming a company that will operate a dark pool, a private trading venue that offers investors a degree of anonymity, the people said, unquote. Now, just before we go any further, a dark pool is a high frequency trading exchange mechanism, all right? That's essentially what it is. To continue, who will now own the new venue? Now the partnership between the companies has formalized, with Fidelity taking the largest ownership position in the new company and other fund firms holding smaller stakes, these people said. The company is expected to launch in the coming days, and trading will begin later this year. The companies each will have representatives on the board and will work together on decision making, these people said. The company that will host the trading venue is called Luminex Trading and Analytics, which was approved as a broker-dealer by the Financial Industry Regulatory Authority on December 26th, according to public documents. Michael Cashel, a senior vice president at Fidelity, will be Luminex interim chief executive, these people said. This is both good news and bad news. It's good because it formally marks the beginning of the end of high-frequency trades, even if it means that Brad Katushima's IEX exchange as a fair provider of a high-frequency trade free market is now essentially dead. Now, let me stop right there. I don't think that's what it means. I think what it really means is that this company is bypassing the middleman, in other words, the other dark pools for high-frequency trades, and merely establishing its own dark pool for high-frequency trades. But we'll get back to that in a moment. Now, to continue with Zero Hedge, quote, the effort is unusual for the fund companies because they are rivals and typically use similar trading venues at big banks or public exchanges. They have banded together recently out of a shared desire to cut costs and weed out high-frequency traders who often have an unfair advantage, according to critics. The companies have also had trouble buying and selling large orders of stock in other pools. The new venue will require all trades have a minimum share amount. It's bad news because as a result of the terminal failure of corrupt regulators to do their job and regulate public markets, a sad fact which is now confirmed as a result of this proactive step by money managers to simply skip markets altogether and start their own private venue. I hope you caught that. Skip markets altogether and start their own private venue. Price discovery for what is left of retail traders is now dead, as the market-making blocks will execute in dark venues on prearranged prices, which will only hit after the fact and essentially establish not only a two-tier, but a multi-tier market. Now, why two tiers? They're saying two tiers because of the high-frequency traders and then everybody else that doesn't have access to the ability to make high-frequency trades. That's a two-tier market. And what they're saying, what Zero Hedge is suggesting, is now that you have these large investment groups setting up their own dark pool, that's a precedent that's going to spread. So you're going to have a multi-tier market with the average retail trader shut out. Essentially, that's what they're saying. And essentially, what they're saying is that the market is going to become even more obscure in the sense of price discovery. It's going to become even more subject to all of these high-frequency trades. That's reading a bit between the lines here. All right. That said, even as broken as it currently is, the market is still a self-regulating ecosystem, and it was only a matter of time before the scourge that is high-frequency trade was not only exposed for everyone, but ultimately wiped out. Now, that's Zero Hedge's take. My take is, as you've gathered, the exact opposite. I think what this means is more high-frequency trades, but now they're cutting out the middlemen who've set up these dark pools, and they're establishing their own directly. Now, the reasons why are what I think are really interesting. The only problem is, pardon me, the only problem is that with high-frequency trade soon to be shunned from equity markets everywhere in its deathly throes, it will focus almost exclusively on the one market where there is still some volume thanks to the central banks and some volatility, and that's foreign exchange. And we, for one, can't wait to see the look on Abe, that is Japan's prime minister, and Kuroda's faces when in a few milliseconds the US dollar Japanese yen trades down from 120 to 0.001 simply thanks to a fat algorithm finger. In other words, the guys that make the programming and punch the wrong button and create chaos in the foreign exchange markets through high frequency trades. All right, now that's Zero Hedge's take. Let me give you my high-octane speculation, and I've given you some of it already. I don't think this spells the end of high-frequency trades. What I think it means is that high-frequency trades are going to be more directly in the hands of those companies with major investing capital, J.P. Morgan and some of the Fidelity Investments and some of these other things. And it's not going to spell the end of high-frequency trading, but rather the reverse, the spread of it and the concentration of the power and ability to make and execute those trades in the hands of that narrow group of people and large investment houses and banks. That's what I think is going on here. The question is why? Now, this is the high-octane speculation of the day. I suspect that we're looking at a story that has a parallel with the BRICS nations, and in particular Russia, attempting to establish their own internal domestic clearing, which we've seen in Russia's case. And I've been arguing that we're going to see the BRICS nations establish their own mechanisms of international financial clearing parallel to the SWIFT CHIPS system in the West. All right. Now, why are they doing that? Well, Secretary Catherine Fitz suggested to me that one reason would be that if you're going to erect a global currency system, a global financial system, a truly global system, then one thing you want to build into that system is redundancy. All right. And certainly you would want to have a parallel redundant system of international financial clearing other than the one that we have now. All right. Now, I suspect that that may be true. I suspect that the BRICS nations, however, are doing it for a very different reason, and that is that the electronic espionage that we've seen the West conducting, GCHQ in the United Kingdom, the NSA in the United States, and so on, that system is part of, again, to borrow the observation of Secretary Fitz, the ultimate insider trading mechanism. In other words, that system gives you the technological capability to rig high-frequency trades. In other words, what I suspect the BRICS nations, and in particular the Russians, suspect, as they're looking at the Western financial system, is that it's no longer the corporate capitals of the West, the banks, the investment houses, the mutual funds, the hedge funds, and so on and so forth, that are driving the vast volume of trade in the markets. I think what they've looked at and possibly deduced is that there's an external influence at work, secretly and behind the scenes, within the Western system of finance, and it's at work precisely through its ability to be able to infiltrate, control, monitor, and even influence high-frequency trades, international financial clearing, most of which, again, are done by computers and electronically. So in other words, they're looking at the intelligence penetration, the intelligence apparatus penetration of the Western financial markets. Now, that leads me to what I suspect may be going on here. I suspect that you can look at the banker deaths, all of which seem to have one thing in common. They all had, at some point, a connection to the ability to read the computer-generated data of financial statements. I suspect that these people may have discovered, and that word is getting around the financial community, that the financial community has lost control of their own financial system and that there's an external influence at work. And I suspect that this may be the hidden, unstated reason for why now you see these big investment groups wanting to start their own dark pool, because they are suspicious of the penetration of an external force in international clearing, within high-frequency trading, within electronic trading on markets. And the key here, as the Zero Hedge article pointed out, was foreign exchange is still very definitely subject to the whims of high-frequency traders. And that, I think, is a key clue, a key clue as to why we see this being done. The next step, if I'm correct, if this high-octane speculation, for which I have not a shred of evidence whatsoever, if this high-octane speculation is correct, then what we will see the central banks do over the next few years is they might attempt to establish their own dark pools independently of any connection to the existing financial system. A key here to watch is going to be the IMF, the Bank of International Settlements, the Bank of England, and so on. If they start talking the same thing in foreign exchange, that's a clue that they think that their system has been compromised by an external source that may be the Western intelligence services or some other source. But this is, I think, a huge story. This is one to watch, folks. Now, let me give you one brief announcement. I have not heard anything about Georgianne. I have not heard from her son, so I do not know how she's doing. The last I heard was that she was sleeping a lot. She's kind of in and out. So I will update you as I hear things. Anyway, that's it for my high-octane speculation of the day in news and views from the Nefarium. I'll see everybody on the flip side, and God bless everyone.